Most ICT traders understand fair value gaps in theory. They know what a fair value gap looks like. They know how to identify a fair value gap, but they still lose money trading them. The issue isn't in finding fair value gaps, it's knowing which ones matter, when they work, and how to actually trade them. And in this video, I'm going to show you exactly what I've learned from 9 years of trading fair value gaps day in and out, to know the right fair value gaps to trade, which ones matter, and how to actually trade fair value gaps properly to take profitable trades. And what's crazy is that once you understand fair value gaps in the way I'm going to share with you in this video, you're going to be able to see that you can actually use fair value gaps to be able to know what is price most likely to do next when you're day trading. But anyways, I don't want to get too ahead of myself. If you're new here, this is day 6 of the 9 years of ICT 25 days of Christmas series, where every day I'm posting a topic on ICT concepts and sharing what actually works and what I've learned in my 9 years of trading them. What are fair value gaps? And it's important that we understand the basic of what fair value gaps actually are in order to understand the information I'm going to share with you in this video. So fair value gaps are the lack of even buying and selling in a price run, which creates an imbalance in price that's then represented as a fair value gap. When price is bullish and in that bullish price run, if it moves too fast without offering even selling, this creates an inefficiency traded area in price, and then that's what's highlighted as a fair value gap. Fair value gaps are important because the market only has 2 primary functions. The market is only ever doing 2 things, which is seeking liquidity or inefficiencies. And if fair value gaps highlight inefficiencies in price, and one of the primary functions of the market is seeking inefficiencies, that means that fair value gaps are high probability draw for price naturally, and price will seek support and resistance at these levels depending if we're bullish or bearish. And if we can figure out which fair value gaps are likely to be drawn to, we can frame high probability trades around them because they're a key function of what price naturally does. And I know some of you guys might be thinking, oh yeah, but how do I frame a fair value gap? How do I know which fair value gap is going to be used? Don't worry, just slow it down. As we progress further into this video, I'm going to give you the insights to what's going to allow you to be able to know which fair value gaps to use and how to frame them. So how do I like to personally use fair value gaps? And in my 9 years of trading ICT, this is what I found that's worked, and that's been the most consistent for me in terms of understanding how to utilize fair value gaps when I'm actually day trading, because as day traders we want to be putting ourselves in the best positions to be able to catch high probability trades. When using fair value gaps for day trading, I have found that the fair value gaps that form on the hourly chart and on the 15-minute chart confluence with the current trading range at the right time of day are very useful in terms of predicting where price should turn from. For example, let's say we're bullish and at the right time of the day, which could be London open, New York open of course, or the 9:30 open, logically if we're going to be bullish, we want to see a degree of manipulation to take place before a true move. So what I always like to think to myself is, okay, where is price currently at right now? So coming up to that time, it could be either the London open or the 9:30 open, right? I'm always thinking to myself, where is price currently trading at right now? And what do? I like to identify the current range, and then I look for a fair value gap in that range, ideally below 50%, because obviously price likes to use discount arrays if it's bullish, and obviously it likes to use premium arrays if it's bearish. Sometimes if price is actually too bullish, what you find that the premium arrays, when we're bullish, like a premium fair value gap in the upper 50% of the range, it's most likely going to use that if price is just super strong and it's super bullish. But typically I like to look for the fair value gaps that are below 50% of the range. So I identify the current range, look for the fair value gap, and if it's easily visible and it's close in price, I anticipate that price will most likely react from there. And that's the key is that you anticipate, and you're not saying I'm certain that price is going to do this, I'm 100% certain. You just have a degree of anticipation based on the logic that, okay, if price is going to manipulate, right, and there's a fair value gap that's relatively close in price, 15-minute fair value gap or 1 hour fair value gap, if one of the 2 primary functions of price is either seeking liquidity or inefficiencies, right, that's a key function that price needs to meet in order for it to start moving higher. And all I do is literally I just wait for price to trade in it. So I'll mark that fair value gap up and I just wait for price to trade into that level, and all I do is literally just trade the confirmation of the respect of that fair value gap. So I don't even need to know if it's 100% gonna react from there. I just wait for price to confirm to me that, okay, it is gonna react from there. And obviously that confirmation could be a lower time frame, so as it hits that 15-minute or that 1 hour fair value gap, I'm dropping down to a 1 minute chart and I'm looking for an inversion, or primarily what I like to look for is market structure shifts towards the intended direction that I actually want to see price going. So that's the confirmation that, okay, this fair value gap has worked, and then I'm just trading in line with the true direction of price. And obviously this is a visual illustration of it right here. So what do? We identify the current range from where price is currently trading. Okay, so price is trading around here at the key open, right? This is what's marked on this red line. That's a key opening time. Could be London session, could be New York or the 9:30 open, right? I look, okay, what's the current trading range I'm trading in? And identify the current trading range. It could be a 50-minute range or an hourly range. And then I'm thinking, okay, within that range, is there easily visible 15-minute fair value gap or an hourly fair value gap? If there is one, that's where my attention goes. So what I'm anticipating is that at that open, I want to see price draw into that level. And then as it draws into that level, then I'm going to wait for my confirmation. I execute in the 10 direction. So yeah, just always get into the mind of, okay, think to yourself, okay, what is my current range? Where's price currently trading at? Are there any confluential levels? And as you build that and you see, okay, yes, there's a 15-minute fair value gap. Okay, oh yeah, it's confluence of an hourly order block open, right? At the right time of day, it's trading down into that. And then, oh yeah, it's confirming the respect of that level. Boom. That's all you need to be able to frame fair value gaps and to know, okay, this one's the one that's going to work. It's always about what's closest to where price is currently trading at, because that's what's going to be the least resistance for price in order to meet the function needs to meet for in order for it to actually start moving in the intended direction. And don't take my word for it. I always encourage you guys to think independently. Just go and forward test this and back test this, and you're going to see I am not bullshitting you. One thing you guys have to know, especially it's important when it comes to understanding fair value gaps and knowing, oh yeah, but how do I know which fair value gap to use for my entry? How do I know this is going to be the fair value gap that works? One thing guys have to remember is that price is not random, right? 15-minute and 5-minute fair value gaps that form at the right time of day under the right context matter. Those are the ones that you're going to be using. And what do I mean by that? Say if I'm bullish, right, and I have my high time from drawing liquidity, or I just have my drawing liquidity, right? All I'd need to do is at the right time of day, simply wait and see that the manipulation has happened. Price has shown a change of direction, which is the confirmation. And all I need to do is literally just wait for the bullish fair value gaps to form on the 15 or 5-minute chart. And all I need to do is simply just get in line with the markets at those fair value gaps. Because if we're bullish, right, this is the logic. If we're bullish and the market is manipulated, because I've literally looked back, okay, I've seen manipulation, right? Price should now be in a buy program. So if price is now creating fair value gaps on these time frames, after the manipulations happen, after the confirmation and the change of directions happen, I will anticipate price to naturally now find support at these levels and then continue higher, drawing to our ultimate level. And this is the kicker now. They become even more powerful if they form during the silver bullet times, where we expect high probability fair value gaps to form. This logic here is your answer to knowing, okay, how do I know which fair value gaps that are going to work? It's the ones that form after the context is in place at the right time of day. Those are the ones that you want. This is a visual illustration of this, right? It's a key time of day, and let's say price is currently trading at this level here, right? All I need to simply do is just look back. Okay, did manipulation happen? We can see at the key time of day, price came lower, took out a kilo, moved higher, broke market structure to the upside, retraded, continued to trade higher, created a fair value gap. This could be the 15-minute chart or the 5-minute chart, creating this fair value gap. I'm seeing all this information, I'm using it. Okay, I have a high time frame draw, I'm bullish. Price is already showing the manipulations in. So this fair value gap, do you think price is randomly creating this fair value gap, or it's intentional with the intention of continuing to trend higher to that draw? Of course it's not random, it's intentional. You're going to anticipate as a trader with great deal of confidence that, okay, I'm bullish, I know price is drawing higher, price is not randomly creating this fair value gap. This is one that I'm going to use based around this context that the manipulation is already in, and that's just going to give you much more confidence in believing that this is the fair value gap that's going to work. And the beauty of it is that sometimes you don't even need to have bias in order to know if price is going to continue going higher or not, and you can just literally just do that by just reading fair value gaps. And what do I mean by that? Just as much as fair value gaps highlight inefficiencies in price, by virtue of the circumstance in which fair value gaps are created, they also help communicate to us what price is doing, which helps us form a narrative and understand whether price is currently bullish or bearish under the right context, which is essential if we don't necessarily have a bias. And that's the key, is sometimes you don't necessarily need to have a bias going into the market. You just can just simply read the behavior of fair value gaps under the right context, and it will tell you that, okay, price is currently bullish at this moment in time. And if it's currently bullish at this moment in time, then you just know, okay, if price is bullish, it seeks key liquidity. What is key liquidity? Previous day's high, previous session highs, daily highs, old daily highs, and so forth, right? And you might think you're because what do you mean you don't necessarily need to have a bias? Okay, let me just explain to you the logic. I hope the logic makes sense. If bullish fair value gaps only form because price is moving too fast to offer even selling within that price run, that is useful information because it highlights that in that moment price was so one-sided that it couldn't even trade inefficiently. And if price is unable to then rebalance that fair value gap, and you got to think about this, right? The core function of the market is to make the market efficient, and the inability of price to be efficient again by rebalancing that fair value gap, this can be very telling to the true intention of price, because it could mean that price is in a hurry to go somewhere. And by blending time and price and asking ourselves, what has price done? Where's it coming from? Is it making fair value gaps and failing to rebalance them? This can help us get an idea of what price is currently doing, and then we can frame trades around these ideas. And these ideas are obviously much more impactful the higher the time frame you go. But in terms of day trading, seeing this transpire on a 5 or 15 minute time frame is enough to help us predict the next likely draw. And of course, I'm going to show you a visual illustration of it, and we're always keeping in mind our important questions. Cool. So we go on our chart and we think to ourselves, okay, where's price currently trading at? Okay, price is currently trading at right here, right? Cool. Where's it trading from? And we just think, look back on the day so far, where's price traded from? Did it trade from a key level? And obviously we're using the 9:30 key open right here. At 9:30, price traded away from a previous day's low. What did it do? Okay, it traded it into a key level, previous day's low, key liquidity. Did it trade into a key level? Yes. Did it show a willingness to move away from that level? Because think about it, we're here right now, price currently trading here. We're just using the information price already given us, right? That's the key here. Did it show a willingness to move away from there? Okay, yes, it traded into that key level at 9:30 and showed a willingness to move away from it by creating a market structure shift after trading into that key level. Did it show speed to move away from there? Okay, yes, we can see that as price made a market structure shift, retraded, even failed to trade into a fair value gap and just started to move higher, and the speed is represented by it continuously making fair value gaps as it's progressing higher. That shows that price is in a hurry. Did it make fair value gaps and fail to rebalance them? Okay, yes, price failed to rebalance these fair value gaps as it was moving higher based on where price is currently trading at. Is there key liquidity or high time frame level? Oh yes, we can see that. Oh yeah, there's a key previous day's high near to where price is trading at. Is it currently high probability time of day? Oh yeah, we can see that. Oh yeah, right now it's currently the 10 o'clock hour. During this time between 10 and 11 New York time is the silver bullet time. Boom. So that previous day's high, which would be the draw here, is a high probability draw that price is going to reach into that, based on the fact that price has come from a key level, showing bullishness by creating fair value gaps and failing to rebalance those fair value gaps. And now it's a key time of day, like the silver bullet hour, where price creates high probability fair value gaps, and we still have a pending draw, our previous day's high, that is trading here. You see how I've just built a narrative that, okay, there's a high probability chance that price is going to draw, and I did that all by literally just understanding these simple questions here, and by understanding the job and the function of why fair value gaps form, and understanding the logic behind why they form. And then I'm able to build a narrative using fair value gaps to be able to know that, okay, price is currently telling me and communicating to me that it's bullish. And these are the ideas I want to leave you guys with. Always be thinking these ideas. Okay, what is price currently telling me? This is how you read price, and this is how you're then able to build an understanding of where is price currently drawn to. And like I said before, don't take my word for it. Go back test it, go forward test it. Use this as a way of improving and increasing your understanding of price, and you're going to see it's going to aid you very well. And just by understanding the logic behind these concepts and using them around the right context, as I'm showing you here, is what's going to allow you to be able to frame high probability trades. So like, comment, subscribe. I will see you guys tomorrow for the next episode.